Rosemary Miller here with Janet Novack, a money and markets reporter for Forbes, here to tell us everything you need to know and do as student loan repayments are set to resume. Thank you so much for joining me today, Janet.
My pleasure.
So, Janet, what should borrowers start doing starting today?
Well, starting today, they have to start paying attention to their student loans. And they may not have done that for 3.5 years because there was a moratorium and because every time you turned around, there was a change in what was going to happen. And they kept extending that moratorium at the last minute. Now the moratorium officially ends at the end of August and payments will resume in October. But before they resume, you have to make sure that the information they have about you is correct and that you're in the right plan to save you the most money. So the simple thing is that 30 million of the nation's 44 million debtors, student debtors, may have a different servicer than they did before the moratorium started. So you need to go to studentaid.gov, the government site, not a private site, and make sure that A, your current address is correct. B, check who your servicer is. Then go to that servicer if it's a new one and set up an account and make sure they have your address. And most importantly, the payoff here is that you may find that you want to switch the plan that you are in for repaying your debt to save money. So that is it's bureaucratic and sometimes the site is glitchy, but there's a payoff here that it may save you money.
So, what
Crucial.
kind of payment plans do they have to choose from? I know there's a new one, Save, right?
Yes, yes. So there's traditional payment is 10 years of level payments and it's all gone. And if you make lots of money and you want to get it out of your life, that's the way to go. But if your debt is very high compared to your income, then you want to look at what are called income dependent repayment plans, IDR. And the new one, Save, is just huge change. Now, most people will do better in Save than any of the other half dozen older income contingent repayment plans. And there are a couple key things with Save to know about it. Number one, it exempts a larger amount of your income from any repayments, right? So the old program it's replacing, which was called Repay, exempted 150% of the poverty line, all right? So and now it's going to exempt 225% of the poverty line.
So, what does
So
that
for
mean exactly?
Okay, so for a single individual, we're going from like an exemption of you don't have to pay anything on the first 27,000 to you don't have to pay anything on the first 37,000 of income. That and assuming you're paying 10% of your income above that level to the government, that alone is going to save you $1,000. That's number one. That's a biggie. Number two is that under Save, if all you have is undergraduate debt, you will only have to pay 5% of your income above that 225%. And if you have nothing but graduate debt, it's still 10% of your income. If you have a mix of undergraduate and graduate debt, then they do a melded rate. So it might be 7% or 7.5% if your debt was half and half. So that's another huge savings. A third area, which sounds obscure, but in 10 years you're going to care about it, is if your income-based payments are not enough to cover the interest you owe each month. They used to take that excess interest that you weren't paying and add it to your debt, capitalize it. They're not going to do that under Save. So you're not going to turn around in 10 years and say, oh my God, I've been paying 10 years and I owe more than I did when I started. Now, again, if you can easily pay off your loans in 10 years, then you may just want to do that. Whereas if you take an income dependent repayment program, it's probably going to be 20 years of payment if you have only undergraduate debt, 25 years if you have graduate debt. And by 25 years from now, if you went to graduate school, well, you're probably paying for your kids' college. So that's kind of depressing to think about. But the
Right.
point is that at the end of the 20 or 25 years, they're going to forgive the amount you haven't paid. There's another reason, a very compelling reason, to do income dependent repayment. If you are hoping for what they call public service loan forgiveness, that means if you work for the government or a not for profit. And I don't mean if you work for an unprofitable company. I mean if you work for a charity or a not for profit. Then you, I know, because lots of us may work for unprofitable companies. But and you have to work full time. And after these 10 years of payments, they're going to forgive what you haven't paid. So that is, spectacular. Again, if you're earning lots of money, if you're an investment banker, then pay it off in 10 years. You don't want to deal with Uncle Sam for 20 years, or you might even find you could refinance at a lower rate with a private lender. But that doesn't describe everybody. There are a lot of people who are going to have trouble making that payment, particularly they may have rented a place or taken out a mortgage or gone on with their life not counting on those payments that had been suspended for 3.5 years. So
Right.
there's actually a calculator on the student government site, the one run by the legitimate one. Do not just Google for a site. Go to studenta.gov, and you can see how the different repayment plans would affect you.